Some other companies that went public about that time didn't do too well either. In hindsight, CDW went public at a bad time. Investors who participated in 3Com's IPO of its Palm division on March 2nd, 2000 were a lot happier at the end of the day. Palm was riding high because its latest device, the Palm 7 series, could actually, get this, access the internet without using wires. Palm expected to offer at a price between $30 and $32, but it actually offered at $38. It jumped almost immediately to $145 per share before closing at $95.06. At $95.06, Palm's total corporate market value was worth more than double the market value of Apple. Another well-known IPO is Facebook. Professors Andrei Kirilenko and Professor Andrew Lowe says that Facebook's IPO was the third largest IPO in U.S. history when it went public on Friday, May 18, 2012. Talk about hype. In early 2012, the issue of more than 337 million shares was already oversubscribed. That meant that there was demand for more shares than Facebook would make available. If you think that CDW's and Palm's stock price behavior on the IPO day is lots different from the rest of the stock market, then you'd be right. Unlike normal stock transactions with thousands of traders, IPO prices are set by negotiation. That means that they can be off by a lot, either too high or too low. It turned out that Facebook's offering price of $38 was a little too high based on the first day. True, it closed at $38.23, but it only managed that because the underwriters bought Facebook's shares after the offering to keep it from falling below the offering price. Facebook went into a long slide almost immediately and was between $20 and $25 per share for most of 5 months from August 2012 through the end of the year. By that measure, the offering price was way too high. VA Linux's offering price turned out to be way too low, to be fair, on the opening day, and way, way too high for a year or two later. VA Linux offered at $30 in December 1999 and closed that day at $239.25. That's a return of not quite 700% in one day. That sure looks like the underwriting syndicate left too much money on the table and VA Linux got a bad deal. Yet, by 2002, it traded below $1. Yes, I said $1. Okay, that's extreme, but IPOs do behave much differently than seasoned shares. Professor Jay Ritter has studied returns on IPOs for years. During the years 1980 to 2012, there were 7,704 IPOs with data he could use. Some IPOs had bad first-day returns, but the average IPO had a positive first-day return relative to the offering price for every single year. The average of those 7,704 IPOs returned 18.6% on the first day. This pattern holds internationally, too. IPOs from most countries, like Norway and Portugal, Thailand and Brazil, all seem to average big first-day returns. That sounds to me as if a good investment strategy is to get in at the offering price. On top of the economic reasons we gave for the offering price to be a little low, like investment bankers not wanting to eat stock, we have the evidence that seems to bear it out. If you do that, though, then get out soon. IPOs have a strong tendency to underperform the market during the 3 to 5 years starting the very day after the IPO. For smaller firms, those with under $50 million in annual sales, that's measured in 2005 dollars, the 3-year returns are beyond bad. They're horrible, more than 35 percentage points worse than the market. For larger firms, it's not so bad, but for firms with more than $50 million in sales, the average return is still 2.5 percentage points worse than the market. It only gets worse in years 4 and 5. I wish I could give you a good reason for this, but at this point, it's something of a mystery. In our next lecture, we'll explore some of the forces that affect stock prices, but which are out of companies' control. We'll learn that there are good reasons why investors spend so much time worrying about the national and world economy.